Well, Happy New Year, folks, and welcome to our first video of 2024. I'm Dion Zukiwsky, Branch Manager, Senior Wealth Advisor, and Portfolio Manager here with you. And today, we're going to look at where 2023 finished off, have a look at what we see coming for 2024, as well as some strategy. In addition, we're going to bring in Investment Associate Rachel, who has some timely information regarding tax-free savings accounts and RRSPs. So in review of last year, investors had to deal with many factors. This included the continuation of rapidly rising interest rates, commodity price yo-yos, inflation worries, and also military conflicts in Eastern Europe and the Middle East. As mentioned in our last video, consumer spending helped to keep the economy moving and corporate earnings intact. Market performance was decent for the first half of the year, got clobbered for a couple months in the fall, and then catapulted higher to finish the calendar. To see more, let's check out a couple charts here. We're looking at some of the world's largest stock markets, and overall performance in 2023 was quite solid. As we can see, the S&P 500, the US market, had a really good year, erasing losses from the previous year. And looking at Canada, in Canadian dollars, we saw some decent single-digit returns. In fact, the only major market that lost money last year was China at negative 13%. What about commodities and bond prices, you ask? Well, this next chart explains more on that. Most commodities dipped lower last year. West Texas Intermediate, or the price of oil, was down about 11%. Natural gas dropped quite a bit, but gold came up about 13%. If we look on the far right-hand side, the red and white bars show the price of bonds. Normally, a steady Eddie defensive type of investment actually dropped last year because of those rising interest rates. People wanted the new bonds, not the old ones. The good news is, prices are rebounding quite quickly in the bond space right now. So put it all together, portfolios held up really well last year and brought along some positive results. So looking forward to the new calendar, what should we expect? True, we're starting 2024 from a high note, and will it continue? You know, here at the Zukiwsky Group, a big value add that we feel we bring to you is being able to sift through the mountains of financial information that's out there and find out what's important and what's not, to help bring some clarity. In fact, I did a simple Google search in preparation for this video of Market Prediction 2024, and it came back with 1.68 billion results. That's billion with a B, folks. So yeah, maybe we need to narrow it down just a little bit. And really for this year, what's important is a couple things big picture and a few on the smaller picture side. The big picture includes economy and interest rates. To combat high inflation, we know that central banks around the world cranked up interest rates during the last few years. As a result, the economy has slowed down, but has not tipped into full recession mode at this time. A bit of a Goldilocks scenario, you could say, in what's called a soft landing. To expand further, a soft landing really means that growth is cooling, but is still positive. Naturally, this is a good thing for investors. Now, the flip side to this is, you guessed it, a hard landing, which means a mild recession, economies contract, unemployment rises, and so on. It's unclear which result we'll totally see, but we should have a better picture about halfway through 2024. The other big picture factor to consider that's of course related to this is interest rates. As world economies cool off, it is predicted that interest rates will come down later this year and perhaps into 2025. Let's have a look at the US Federal Reserve's predicted interest rate curve here. So as we can see by the blue line, the last couple years have really cranked up interest rates. And we use the US Federal Reserve because the US is still the world's largest economy. So rates have come up very, very quickly. And now when we look at the red dotted line, it shows that rates are expected to start coming down. In fact, there's about 6 interest rate cuts that are built into market predictions at this time. So with this in mind, if central banks do not follow this path, leaving rates higher for longer, we'll likely see some increased market volatility. Now moving from big picture to smaller, the other major factor we're considering is what's called corporate earnings. Now this is a case of optimism meeting realism. Predictions in both Canada and the US are for a turbocharged earnings recovery almost to record levels. And it will remain to be seen if this will play out because wage costs are higher and so are borrowing costs in corporate America and Canada. Of course, this will vary across different sectors in the economy, which will also impact investment selection into our models. So with that, let's check out strategy. how should we be positioned for the coming year? Although we're definitely more constructive on growth areas like equities and portfolios, we know there's never a straight line in the investing world. Given the strong rally to finish the year, it is possible we'll see a dip as a lot of good news is already priced into the markets. However, from what we can see, any pullback should be viewed as an opportunity as we still are positive on the next 12 to 24 months. Now, will the Goldilocks economic scenario of a soft landing play out? Obviously, if it continues this way, growth investments will perform really well. However, this isn't a total lock or guarantee. And that's why it's always important to consider other investments such as fixed income or bonds, as well as alternatives like real estate and private equity to help keep risk in check. Finally, let's remember why we're invested in the first place. A wealth plan helps to define your goals and will ensure tax efficiency by making sure you have the right investments in the right types of accounts. These include things like tax-free savings accounts and RRSPs. And for more on this, let's bring in Rachel to explain further.
Hello everyone and Happy New Year. Today on our Did You Know segment, I'm going to briefly discuss contribution limits for 2024 in the tax-free savings account, the RRSP, and the first-time home savings account. As you know, the contribution room for the tax-free savings account is announced as the allowable contribution amount for that year. This year's room is $7,000. Remember, there is no tax expense to investable income earned inside of the TFSA. You can have these contributions go directly from your bank account to your TFSA on an annual, biweekly, monthly basis, and we can help serve you in this process. The RRSP room will be set on an individual basis of 18% per the individual's last year's earned income, up to $31,560. Remember to get your RRSP contributions in before February 29th of this year. We also have some new and exciting information about the first home buyer's savings account. This will be a nice tool to use if you have children or grandchildren that are hoping to save up for their first home. There's many benefits to this account, and the contribution limit for 2024 is $8,000 with a lifetime limit of $40,000. If you haven't already set up your pre-authorized contribution plan, please be in touch with our office today and we'll be happy to assist. It's easy. As always, if you have any other questions, please reach out to the office and we'll be happy to help. Thank you for watching.